Let's bring in our market expert, Sam Stovall, Chief Investment Strategist with S&P Equity Research. Joining us from their S&P offices, George Antonopoulos, President and Chief Investment Strategist for WallStreetEye.com, here with us in our New York studios. Sam, I want to start with you. We are in the middle of earnings season. A lot of corporate earnings for the third quarter have been decent. Forecasts for the fourth quarter have been downright ugly. Is that what is making this market so nervous?
Well, Cheryl, I think it's a good point that what we're probably experiencing is what I would call a top-down turnaround. By that I mean that investors, instead of focusing on the more optimistic bottom-up estimates, which are actually calling for about a 40% increase in results in the fourth quarter because of easier comparisons, and are looking for more than a 30% increase in 2009, now investors are focusing more on the top-down estimates, or those generated by economists based on real GDP projections, and are traditionally much more conservative, and I guess this year you would call them pessimistic than the bottom-up estimates. And so as a result, I think basically investors are readjusting their year-end and 12-month targets based on these differences in earnings.
Sam, I was really struck by your notes of the fact that analysts are looking for an increase of 33% next year in S&P earnings, and economists are looking for a 5% decline. That spread is huge. And besides that, I don't know any rich economists out there.
Well, that's a good point. And also, economists sometimes talk with two hands, because if in case we do find that the lower gasoline prices ends up providing a stimulus package similar to what we experienced from the government earlier this year, if we find that the 8 interest rate reductions, now likely to be 9 in our opinion by the end of this year, combined with a second stimulus package, which we think will be coming through in the early days of the new administration, you know, those three things could cause GDP to be positive in 2009, not negative as we currently estimate.
Well, George, we are trying to look ahead to 2009 right now. So let's talk about the coming quarters. We are getting fourth quarter projections, as I mentioned earlier, from companies that are not very positive. But at the same time, over time, markets do perform to the positive. If you look at the historical perspective of the S&P, for instance.
Absolutely, Cheryl. Some of the earnings are coming above estimates, some are coming below estimates, but a lot of big, large cap companies are providing positive earnings on a consistent basis, and we're just looking for small tidbits of good news moving forward. And the S&P 500 has been up 117% since 1993 over the past 15 years. So absolutely, over the next several quarters, it's going to be very choppy. But these are the times to, buy some very low, inexpensive stocks right now, historically speaking.
Okay, buy low, sell high. James, what are you telling your clients right now?
Well, look, there is America on sale right now, and you don't have to work very hard. You can go with big bellwether names like Caterpillar, 3M, Pfizer, and get low multiples, great dividend yields. And although the dividends may vary over time, it gives you a great tailwind to start with right now. So you really don't have to work very hard.
I love the Pfizer call, but the Caterpillar, the 3M, it's so tied to the global economy. We know what's going on. Look what's going on in oil prices. It's literally dragging down Brazil, dragging down Russia, dragging down to a certain extent parts of China, which, CAT and 3M, they're going to be very, very much tied to that international growth picture, which is kind of in question right now.
You're making a good point about emerging markets, which got killed yesterday, Brazil in particular. So that's a big portion of a portfolio.
And not to get into a back and forth, but here would be the counter argument. Caterpillar is going to earn $6 a share this year. It's trading at below $36. Now, certainly next year, it's more than likely going to have a down earnings year. But at 6 times this year's earnings, what's it going to go to, 7 times, 8 times next year's earnings? I'll buy that, especially with a 4% dividend.
Whereas the Pfizer, I think it's going to return you about 7% with a ton of cash in the bank. For me, that's the safer play. I like that one better. By the way, I've been a big fan of global growth. I just don't think it's going to be around this year.
George, let me go to you, because a lot of times you'll bring stock picks to our show. So if you're a smaller investor, do you look for small cap stocks? Do you go for the smaller plays that are maybe a cheaper play?
Sure. Well, before I get to the small cap idea, Johnson & Johnson is a very defensive stock in a recessionary type of environment. J&J will pay you a 3% dividend, and the PE ratio is 9. So that's a very, very cheap stock, J&J, and it's very defensive, and you can just set your dividends to reinvest, and that's a great defensive play. And then a low-price stock right now is Ford Motor Company, trading just above $2 a share. Now, we can make the argument that Detroit has a lot of challenges, But
well, I'm glad you got to your stock picks. I wanted to talk about the small caps, but that's okay. We're going to have to leave it there. George Antonopoulos, thanks for being with us. Sam Stovall from S&P. We appreciate it, guys. And, of course, to our own experts that are right here in the studio. Lucky to have you. We are all over the